Welcome to SilverOak's quarterly webinar. The webinar is scheduled for 60 minutes, and a copy of this will be posted to the SilverOak website afterwards. As usual, if you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. If you're not currently working with a SilverOak advisor, feel free to contact me directly at 952-896-5701. And of course, I want to put out a big thank you to Jonathan, who's with us today, and John and everybody else on the team that makes these quarterly webinars possible. It really does take a village to put all this together. And for compliance reasons, I also must note that we will be discussing the overall markets and economy during this webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We will also not be discussing specific portfolio performance with SilverOak, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports within the last couple of weeks here. If you have any specific questions with regards to that information, please contact your SilverOak advisor if they have not already contacted you. And lastly, past performance is no guarantee of future success. So with that, I'm going to forward here to the agenda. And Jonathan, I guess I didn't do the formal introduction of you, but with us today, as I very briefly alluded to, is Jonathan Charlo, our lead analyst and one of our partners. So thanks for joining us, Jonathan.
Thank you, Shannon.
So on the agenda today, we are going to go through a review of the economic data for the quarter. And after having that discussion, we'll transition into the market data. We'll also review past bear markets and more hopeful, right, recoveries, because recoveries do always follow bear markets. And I like to remind everybody of that because, of course, we are in a kind of a down market right now, but things will get better. In that regard, we will talk about SilverOak's outlook and when we think things will get better and what that might look like. We'll also provide some SilverOak updates with regards to happenings here within the organization. And like I said, if you have questions, we certainly encourage you to reach out to your advisor. And I would also suggest if you have any suggestions for future topics, reach out and share those suggestions with your SilverOak advisor as well. So Jonathan, you put here the economy had mixed signals for the quarter. What do you mean by that?
Well, we're seeing factors in the economy that are holding up, and we're seeing other factors that are slipping. And so again, it's kind of giving a mixed picture. Now on the dashboard, you'll see that in the second quarter, it's currently green, but we have been receiving data points that suggests that by next quarter will be neutral, and if those trends continue by the fourth quarter, we'd actually factor the economy as being negative.
So just to remind everyone, maybe the new folks on today's webinar, that when we're looking at the economy, it's one of four components of the dashboard, and obviously it's laid out in a quarter by quarter basis. And the circle there is showing the current second quarter data with that transitioning to gray as you just alluded to. How about the other three components of the dashboard?
So the credit markets are still green and next quarter are projected to be green. Now, obviously interest rates are increasing, but in terms of the overall health of the credit markets, they're still positive. Now, we've talked many times about valuation, and obviously with the markets being down so far this year, valuations are less lofty than they were, and we'll show that later, but they're still a little bit negative, and they are projected to remain negative and maybe by the fourth quarter, they might be neutral. But it's still a negative factor. And obviously, market sentiment is terrible right now. And we'll have a couple slides where we talk about some of that sentiment. But you know, that had been kind of neutral, but with the declines we've seen in the second quarter, it's solidly negative.
So as we combine all of these components to look at the composite, we'll see that we did slip from a more positive position in the first quarter of the year to a neutral position in the second quarter, with an anticipated transition further into kind of negative territory for the composite in the third quarter. And we'll actually see that when we look at the dashboard in these terms, where this is looking at the current dashboard kind of composite number and then the 6-month average. And in both cases, they're obviously trending down from where they had been. And as far as the current composite goes, that's actually now broken through what we consider to be an important threshold, while the 6-month trailing is still kind of right at, I mean, literally right at the threshold. What does that give us a sense for when we start breaking through that threshold?
Well, in the past, when we break through these thresholds, what the dashboard is really telling us is that the likelihood of equity outperformance relative to fixed income would be low. Doesn't mean it couldn't happen, but it means the current environment really does not necessarily favor equity outperformance. And we'll talk about that when we look through the bear markets and kind of where we're at. So that's shouldn't be surprising.
Sure. All right. Of course, one component of kind of the overall economy that's really had a real heavy weight on the economy is energy, and that's been a tough one.
Absolutely. Everyone's been talking about inflation this year. Why hasn't it peaked? Why last month was it so high? I think the answer is that without the Russian invasion of the Ukraine, we might have actually seen inflation peaking a couple months ago, but we did see a further spike in oil prices. Now they've come down a little bit, so maybe that suggests the next couple months might moderate inflation. But when you put that along with food costs, that has had a major impact on inflation, and it is starting to bite many consumers, and that potentially could start affecting growth.
Well, and you mentioned growth. Let's talk about GDP overall, which is gross domestic product. How has that been faring over the last couple of months or quarters?
Yeah, so last quarter, surprisingly, we saw a negative GDP quarter, down about 1.6%. And the projection for this quarter is kind of in that 1% range. Now, the Atlanta Fed does track GDP throughout the quarter, and they call it GDP now. It is not a perfect correlator with the actual GDP that's reported, but it gives us an idea in the trend. And unfortunately, based on data received in June into early July, that actually turned negative, about a negative 1%. And so if that really suggests that GDP for second quarter comes in flat or negative a little bit, it really does mean everything that we've been talking about, inflation, higher fuel prices, higher food costs, are definitely affecting the economy.
Now, there are some bright spots, though, and we're going to go through a couple of those. Earnings are still expected to grow. Now, these may be a little bit optimistic, but nonetheless, they're still expected to grow.
Yeah, so starting the year, the thought was that earnings this year could be up 8 to 10%. So far, we've kind of seen it more in the 7% range. Now, I wouldn't be surprised in the second quarter earnings reports if that guidance for the second half comes down. But again, typically in recessions, you see negative earnings growth, meaning they decline. We're not there yet.
And another place that we've seen some strength is in the employment markets, and job growth remains pretty strong.
Yeah, absolutely. That's been kind of a bright spot. Last month the job numbers were surprisingly strong. Although recently we've seen some other sort of job numbers that have weakened a little
Yeah, just
bit.
this week, I think the numbers came in a little weak.
Yeah, that would be the weekly jobless claims.
Yeah,
Those
yeah.
have been ticking up a bit.
Right. And I think the Philadelphia Fed Manufacturing Index that came out this week too had some kind of negative numbers within it regarding to both employment and manufacturing. So,
And then anecdotally, you're starting to hear some tech companies talking about some strategic layoffs. I do think that maybe hiring will slow down because even some companies that don't lay people off, they might just allow attrition to occur.
sure. Thus far though, employment has been strong. We're starting to see maybe some cracks in that armor, but it's held up and hopefully will continue to do so. As we look at these factors overall though, we put them here on this scorecard. And we were talking about energy prices, which really fall at the far right under the negative commodity prices is where we'd have that. But walk us through a couple of these that have the negative signs next to them, signifying that we actually downgraded, in this case, from one category to the other, from positive, in this case, over to neutral.
Yeah, so monetary policy, housing, and fiscal policy were all moved from the positive column last quarter to the neutral column this quarter. Monetary policy, we basically have less stimulus. Housing is being affected by higher interest rates. Now, what that likely means is fewer sales. Now, we've heard that prices seem to be holding up, but we know refi activity is down, new home sales activity is down as well. And then from a fiscal policy standpoint, with high inflation and this being an election year, we're probably not going to get any further fiscal stimulus this year. And then on the negative column, we did move consumer confidence from neutral to negative. We're going to actually show a slide later on, but consumer confidence has really plunged in the last quarter.
As far as sentiment goes, we do have some arrows down showing our sentiment going forward is maybe a little bit less positive, but not, it hasn't moved enough to actually shift this from one category to another.
Yeah, so credit conditions are still positive, but are trending down. Now that was the same in our dashboard. Interest rates are up in the last quarter, so we have the downward arrow. The US dollar has been strong. That's actually creates a downward arrow because it does hurt international returns, but it also does hurt US manufacturers from an export standpoint. And then with everything going on in Europe with the Ukrainian situation, we're seeing global growth down, we're seeing Eurozone growth down. We'll mention it later, but obviously China with what they're dealing with COVID and lockdowns, that's also having a negative effect on global growth.
Yeah, so again, looking back, I mean, these are always tough discussions to have during periods where we're just kind of in that late phase of the cycle. But obviously it's a lot of negative, but we have to reflect back. Consumers are still strong, which we'll talk about. Employment's still strong. So as long as those two hold up, it's hard to imagine that we're in a recession. It's just a question of whether those two really hold up. Having said that, and looking back at the economic data, it's probably going to be no surprise to hear that as far as the markets are concerned, there really hasn't been much positive here. There's few places, as you put, to hide. And we'll see that on this slide here. With all of the equity markets in negative territory for the quarter, and actually slightly worse on a year-to-date basis. Now, to put this in perspective, though, we are coming off of 3 very, very strong years in the markets. So yes, we're technically, I guess, in that bear market cycle, but it's after having 3 years of just really, as I mentioned, exceptional performance. If we look at this next page, I think this is where maybe investors get a little bit spooked. To see that bonds are down as much as they are, not just on a quarterly basis, but on a year-to-date basis, with the Bloomberg Ag, which is kind of the U.S. bond market as an aggregate, down 10%, at least as of 6/30, 10%. Now I know it's come back a little bit, and I think it's maybe down 8% or so on a year-to-date basis now. But that's that's pretty tough, I think, for investors to see when typically bonds are, I explain them as kind of the shock absorber, right? They're the safe haven asset that's not necessarily supposed to go down when equities are down so much.
Yeah, that's absolutely true. But on a positive note, in the last 3 or 4 weeks, bond performance has been a little bit better and has provided that cushion relative to equities. Now, the other thing we did talk about in the letter we sent out last month was commodities. And so the interesting thing is, while they're up strongly for the year, they actually were down in the second quarter. And we made a point of saying maybe it was a little bit too late to put in new positions in commodities. Because I think what we're dealing with now is just the sort of fear that growth is slowing, we're potentially going into a recession, and typically we do see commodity prices come down. Sure. In that environment.
Sure. Well, and in full transparency, we don't do a lot of investing in commodities anyway, because they can go years of underperforming and then have a short period of significant outperformance. But investor biases make it hard to stick with commodities through those long, very lean years where everything else may be outperforming. And they're very volatile, obviously.
Absolutely.
So you mentioned here, as we think about equities, you mentioned that value has held up better than growth. So, thinking of value being like financials, insurance companies, things of that nature. Growth, typically maybe technology, and this is maybe a little too simplistic in explaining, but talk through this value outperforming growth cycle.
Yeah, so value tends to be economically sensitive. It is a little bit more commodity oriented. So as you mentioned, financials had been doing very well. But more importantly, recently, we've seen energy stocks definitely up. Now they are down in the last month or so, but transportation, manufacturing, all of those, all of those things were holding up better relative to the growth side, which is more dominated by consumer discretionary and technology. And so really when we look at that, everything is down now, but you're seeing that growth is down more as a result.
And that's true both for the quarter, which is shown here in the yellow, maybe. I'm colorblind, so I think yellow, orange,
and then blue,
and then
for the year to date.
Exactly.
Yeah. Exactly. But another way just to put it in perspective, of the top 14 stocks in the S&P 500 this year, 13 of them are energy stocks, and that differs in past years where you would have seen that list dominated by tech companies.
Sure. How about international? What are we seeing in the international markets?
Well, international markets are down, but there is a little bit of a silver lining, which is that they've actually done a little bit better than the US in that they're down a little bit less. But that's also interesting because the dollar in the second quarter was so strong. And so when we translate that back into dollar terms, typically that has been what causes international in recent years to underperform, but it actually wasn't as big of a factor. And in fact, 6 of the 7 components that we're showing here on this slide were down less than the roughly 16% loss of the S&P during the quarter.
Well, and I just pulled up some information right before the start of our webinar. The MSCI ACWI ex-US, which is shown here, it's the second from the right. It's down 18% on a year-to-date basis, and this is, of course, as of 6/30 data. If it were in local terms, it would be down about 11%. So you can see the impact that that currency really did have on the conversion of those. And compare that 11% versus what we saw in the S&P 500 as of 6/30 year-to-date, which was down, I think it was around 20%.
Yes. So we've heard a lot about when will international start to do better. Well, unfortunately, it happened in the second quarter, but it didn't really help in that sense.
Do better just means lose a little less. Yes. Yeah. And I know that provides very, very little comfort to investors. Let's talk about bonds. So we went through the equity markets a bit, but what about bonds? Because again, I think this is where investors have been spooked.
Yeah, we've seen interest rates up substantially, which has hit bond returns. So on this slide, we're showing the bottom group of dots with the line. That's the yield curve, or just showing the yields of the different maturities as of year end. And then right above that, you'll see where they were at June 30. And you'll basically see we had an upward shift in all of the interest rates. But just to highlight how dramatic it's been, here we're showing the 10-year at 1.5% at year end. It has almost doubled to 3%. And then when we look at the 2-year, it was 0.73%. Now it stands at 2.92% as of June 30th. And that's because the Fed has been raising interest rates aggressively. So we have seen a more of an upward shift in short-term rates than we've seen in 10-year and the long ones. And the reason that's important is we've talked about the yield curve inverting. We'll show that later, but we're kind of in that situation where the yields on those 2 years are actually now above those 10-year yields.
And just to step back, for those that maybe don't follow this information quite as closely, as Jonathan mentioned, the Fed has been aggressively raising interest rates. And the reason that they're doing that is to try and fight this concern around inflation. Typically, inflation is the byproduct of the economy running too hot, too fast. So I always like to explain it, you know, the Fed, when they want to put the brake on the economy, they raise interest rates. If they wanted to put their foot on the accelerator of the economy, they'd lower interest rates. And there's that kind of good middle ground. And right now we're going too fast. So the Fed is putting the brakes on the economy, trying to slow it down so inflation will come down a bit. The balancing act is putting your foot on the brake, but not actually stalling the economy or stopping the economy. And that's where we talked last webinar, right, Jonathan, about what's the odds that we could get this, quote, soft landing. So if you haven't listened to last quarter's webinar, I encourage you to listen to that, and we'd go through some of that discussion. So bonds were hit by rates and concerns with the economy, which then led us to those returns that we saw a few slides ago, pretty much negative across the board.
Yeah, so here we're looking at returns across the different bond categories in the second quarter. And to the right, you'll see that they're down a little bit less than to the left. The left side is really kind of those areas that are more affected by the economy and kind of the credit markets. Those on the right are really more affected by interest rates. But altogether, everything has been down.
And that's true both for the quarter and obviously maybe a little bit worse as we can see for year to date. But, you know, after looking at this, I think it's important that we put it in some type of historical perspective. Because as I mentioned earlier, this is pretty unusual. As a matter of fact, you pulled up this chart for us, Jonathan, showing that the intra-year decline we've seen so far of about what, negative 13% year to date was kind of the lowest point of total return. That's really the worst that we have going all the way back into the 70s.
Yeah, absolutely. And so negative bond returns are rare. In this case, before this year, we really only saw 4 instances going back to the mid 70s. And then, as you mentioned, just the magnitude of the decline this year. And again, being caused by the Federal Reserve having to be so aggressive in raising rates to combat inflation.
Sure. Well, and the other thing that I gleaned from this is, I always hear people reference back to the late 70s or late 80s with the higher interest rates, thinking that bonds must not have done very well back then. But obviously we see that that's not the case. It's not, that they did stellar, but they weren't negative. As you mentioned, negative calendar year performance in bonds is quite unusual. And I hate to say it, but if we do end up negative this year, it will be the first 2 consecutive years of negative. I think going way back, way past this.
Yeah, and we've talked during the last year or two about how the pandemic has made history. And,
Yes.
and I think we are witnessing it right now.
Yes. Now, we did talk about the fact that it is unusual not to have that security that you normally get in bonds when stocks are down. And as a matter of fact, this chart is showing how unusual that correlation is by having stocks and bonds down in the same cycle.
Yeah, absolutely. So, here we wanted to kind of point out where we're at this year versus the last 2 times. So bonds, again, are down 9% currently, but in the other 2 instances where both bonds and stocks were down in the same year, nowhere near that magnitude. So 1969, bonds were down about 1%, and in 1931, down 2.3%. I would hazard a guess that everyone would be happy with those negative bond returns if we had those this year.
Yeah, no kidding. Well, and we'll talk a little bit about that in a few minutes and what our perspective is as we close out the end of the year and where we think bonds might move. I mean, nobody obviously really knows for sure, but where we think bonds might move and also where we think equities might move. So let's talk about past bear markets and past recoveries. And to do so, we really need to start with where we think we are in the business cycle. So, our perspective is we're probably closer to that late cycle phase than, maybe the early part of the business cycle. So what do we typically see in the late cycle and maybe as you go into recessions? Well, first is growth. Obviously, in the late cycle, we start to see growth moderate, and obviously in recessions, it then falls. What about unemployment or employment, John?
Yeah, so employment, we've said, has been holding up. And so typically late cycle, we tend to see job losses just beginning to rise, and we've kind of hinted at that, but we're not in that phase of a recession where they're accelerating yet.
In credit conditions, you touched on that earlier.
Yeah, again, on our dashboard, still positive, but with kind of a negative bias. We're seeing the same thing. We've talked about, and we'll show the fact that yield curves are beginning to invert, but we're not yet there where banks have really dried up access to credit for companies.
Sure. Monetary policy, of course, we've already talked about the Fed beginning to tighten in that regard and probably continue to tighten. At some point, if we do hit a recession, you would anticipate normally the Fed would then ease back, kind of getting to the analogy that I was using with, putting your foot on the brake or foot on the accelerator. We touched on corporate profits a bit earlier, with them typically coming under pressure as you go into the late cycle phase, and then of course declining in the recession. And inventories, we really haven't touched on inventories yet.
We've seen inventories increase in certain parts of the economy, but I wouldn't say that we have a lot of inventories. Now, last month or 6 weeks ago, certainly Target and Walmart had some sort of issues, but it's not widespread.
Right.
And in fact, because of the pandemic and supply chains, what we've really seen is kind of a tightness in inventories. So there, I think we could see them rise if we maybe see activity catching up on the manufacturing side, and then growth in terms of demand starts
Sure.
to slow, but we're not there yet.
Well, and some of the inventory, I think that some companies got caught with was really quasi-pandemic related, because it was so hard to get stuff that they probably were ordering more than they normally would, because who knows, it might take you
Right.
3 months or 6 weeks to get goods that normally would have taken you half that time.
Yeah, absolutely.
Now, you mentioned the inversion of the yield curve, and that's where the 2-year bond interest rate actually is higher than the 10-year. And this chart here, Jonathan, is that showing us that relationship?
Yeah, and so here what we're looking at is that differential, and what we're seeing is that it is now inverted. Now, it inverted for a very brief time back in March, but what I will say, this is through June 30th, and so we've been monitoring this through July, and it has been inverted this entire time. Now, in past webinars, we've mentioned that there is a lag between an inversion and an actual recession that can be, 6 to 12 months. But we've also talked about how it needed to be a bit more inverted, closer to the 25 basis points to 50 basis points, and for multiple months. Well, we're not there yet. Unless things change, it kind of appears that 2 to 10 year is inverting.
Well, and this is just showing the 2 to 10. There's another chart, I think here on this very next page, that has more of a composite.
Yeah, so absolutely. So we're kind of showing where we are now versus where we were last quarter. And so right now, we're kind of in that 45% of all of the yield curves have inverted. And last quarter, it was about 20%. So the trend is unfortunately not our friend right now. Now, in the past, we've seen recessions when we've seen inversion kind of in that 70% range. But even when we think about the pandemic, which was a little bit less than that, it's highly suggestive. We're going to continue to watch it, but unless conditions improve, we're probably going to see more and more of these invert.
Sure. So thus far, we've talked a lot about the economy, recessions here over the last few minutes. But tell us, how does that really relate to the markets? Because the economy and the markets are not the same.
Absolutely. So on the top half of the slide, we're showing different bear markets throughout history. And you're going to see some are kind of with that red dot and some with a blue dot. The red dots are those that were accompanied with an eventual recession, and the blue dots, not as many. We have had bear markets without a recession. And so we wanted to kind of compare what that would look like kind of for us right now in either case. And so if we look at the average change on the bottom half, if we're in a bear market without a recession, we're looking at about a 29% decline. With a recession, it would be kind of 32.5%. A little bit of a difference, not that much, but again, I'd point out that from that perspective, while we're down, we're not quite down yet to that average. Where I think the real distinction comes in is that duration or length of the bear market. If we don't have a recession, that's highly suggestive. We're kind of 7 months in, we might have a couple more months, but then if the data starts to show kind of an uptick, we'd probably see the markets rally with that. Now, with the situation where we might be slipping into a recession, it means that the bear market and the volatility we would expect around that could last through the end of the year into the first quarter.
So what would we need in order to get back to kind of the all-time highs from earlier this year or late last year?
Yeah, this is an interesting one because while we're kind of dealing with that volatility and potential downside in the short run, as long-term investors, we kind of have to look at the situation and see if we were to put fresh money in the market, what would our returns be? And so when we look at that 1 year, we're talking about a 28.5% return. That's a really good return. Now, it doesn't always happen that way, but I think anyone would certainly love to have that kind of recovery return. And we did see something like that in 2020. But then if we look out and say this recovery takes a little longer, then we're looking at 2 years and 3 years. Cumulative returns would be kind of in that 30% range, but the annualized returns are still very attractive. 14% annualized at 2 years, 10% annualized at 3 years. And the reason that's important is we do know bear markets, their recoveries are kind of in that 2 to 3 year range.
Right. Yeah. Maybe a little bit longer, but nonetheless, any of those numbers, the 10% would be, that's kind of a historical average, maybe just slightly less if you're in all equities.
Yeah, absolutely.
So what are we seeing here? Because, when I look back at that last slide, and it showed a 1 year performance of 28.5% to get back to break even, the first reaction is, well, geez, that's impossible. But what is this showing us relative to kind of history and what we might see?
So here we're showing all the declines since 1950, where the market was down 20%, and then we're showing kind of the returns 6 months later, 1 year, 2 years, and 3 years. And so what we can see is the average return 1 year later is about a 15% gain, and about 70% of the time we saw those positive returns. Then if we look at it at 2 years, we're looking at a 26% return. Again, a relatively high percentage. And then when we get to that 3 year, what I would point out is the percentage of those instances where we're positive is approaching 90%. The return isn't maybe as high as you'd hope, but it does include a couple of instances where we had multi-year bear markets. And so that was actually affecting that 3 year.
Good point. So you had mentioned consumer sentiment earlier, and that it hit kind of low lows. And I always think about, okay, are there correlations with some of these data points and what happens in the markets? And that data point, the consumer sentiment, it's an interesting one, because you put together for us here on this slide how the consumer sentiment historically has been a contrarian indicator. So walk us through the data.
Yeah, so contrarian indicator, what that kind of means is that when things are bad, that's actually good and we see positive returns. And so we're at really, really low levels. And so here what we're showing is that at turning points, the 12-month return of the S&P is things that will circle. So back in October of 1990, at a relatively low level, 12 months later.
The line is the consumer sentiment line. And that point, it was really low, that blue dot's representing that low point?
Absolutely. Okay. And then the return that you're seeing is the S&P return 12 months later.
Yep. So 12 months after October 90, when sentiment hit the bottom, it returned more than 29%.
Yeah, absolutely. And so then we wanted to highlight a few others that were at levels kind of approaching where we are right now. So February of 1975, May of 1980, November of 2008, August of 2011. And you're looking at 22% return, 20, 22, 15. So suggesting when we're at this low, in the past at least, we have seen double-digit S&P returns in the next year.
So consumer sentiment is not a good gauge, or maybe it's a completely negatively correlated gauge to what investors should actually do.
Right, absolutely. When consumer sentiment is really high, you could actually have negative returns.
Right,
so
right. Interesting. Of course, no guarantee that the history repeats itself, but nonetheless, it's an interesting data point. And this one I like too, because I do think a lot of investors confuse the economy with the markets. And they always believe, or many believe anyway, that if there is a recession coming, the stock market's just going to keep going down and down and down until the recession's over. But history doesn't really show that. History actually shows us that the market bottoms before the economy bottoms. And what you've pulled together here is information on several of the last periods of recession. And this is showing that in 1954, the bottom of the market occurred well in advance of the bottom of the economy. Same during the Eisenhower recession, bottom of the market, quite a bit later, bottom of the economy. And in each of these cases, that trend is true.
Yeah, and the other thing I would point out is every recession, every bear market bottom and recovery is different, but the commonality is that the market bottomed before the economy in all of these cases.
And we see that also here on this slide, where this is a market composite. Down the very middle of the slide, you'll see the red line from top to bottom. That is the end of the recession, or the composite anyway of the recessions. To the left of that are the months prior leading up to the recession. To the right are the months after the recession. And just as we were talking about in that prior slide, market composites bottoming well before the recession ends.
Yeah, absolutely. Now, not to confuse everyone though, we will have to point out that the recession being called, at the start and the ending itself is a little bit lagging.
That's true.
Because the National Bureau of Economic Research looks at the data and then tells us when the recession started. We might all have already known we were in it, but it officially comes out sometimes 3 to 6 months after that. So
I'm glad you point that out, because the other thing is, I've been hearing from many folks that, well, if we get another negative GDP print, you were talking at the very, very beginning of today's webinar,
right,
about first quarter being negative, and now the Atlanta Fed says maybe second quarter will be negative. And if that's the case, a lot of people have concluded that we're all of a sudden automatically in a recession. Just to be clear, that is not the case. So the National Bureau of Economic Research calls these recessions, and they call them based on a number of factors, not based on just 2 consecutive quarters of negative GDP. So with that, let's talk, Jonathan, about SilverOak's outlook and what we anticipate over the next couple of months or quarters. So starting with the US economy.
The consumer is still well positioned. We've talked about this. We're actually going to have a slide showing that. Fiscal and monetary policy is decreasing liquidity. That's a concern. We've kind of talked about this, but there's a rising but moderate recession risk. And the issue is, what will the consumer do? Will earnings and job growth continue to hold up? And then, we will say is that we have seen a recent decline in commodity prices that could be helpful for inflation as we go through the year. Internationally, global growth is slowing with the oil embargo, energy embargo due to the Russian invasion. certainly prices in Europe are up. They're kind of on the brink of a recession. China is an interesting case because they're dealing with COVID slowdowns due to lockdowns. But the other side of that is that they're in a completely different policy position where they're really trying to put the gas on. And one of the interesting things was last quarter, we actually saw the Chinese stock market up a little bit. But globally, we're going to see less fiscal and monetary policy help, and it could actually become a headwind.
So we mentioned the consumer a couple times. Consumer is so important because they drive 2/3 of the U.S. economy. And we came off a period of very strong savings, really driven off of free money the government was giving out over the last couple of years with COVID. We all have started to see that savings drawdown occur. The question is really, will that continue or not?
Right. But there's still $2 trillion in savings accounts relative to pre-pandemic levels.
Good point.
And it's kind of one of those where will consumers continue to spend because they have the money, or will they kind of pull back because of kind of that consumer confidence issue?
Or because if employment starts to deteriorate and unemployment starts to rise, maybe they stop because they're not real comfortable. They'll have a job in 2 months or 3 months. I mean, right now, we've been through an employment situation where, employees really drive most decisions. Employers, might get back into the seat of driving some of that.
Yeah, good point.
Fed?
Yeah, the Fed is raising interest rates. We know that. You can see that kind of upward shift in 2022. And again, that's causing short-term rates to increase substantially, and in many cases are now above kind of more intermediate and long-term rates.
And next week is a big week because we have another Fed meeting.
Yes.
And they're supposed to raise by, I think consensus right now is 75 basis points.
Yes, last week, a day or two, there was a thought of a full 1%.
Yep.
So that's still possible, probably not likely.
And just to let everybody know, the Fed actually meets 8 times a year. So they'll have the July meeting, then they have a September, November, and December meeting. And so we'll have a slight pause in August, but we'll still have 3 meetings after this next one next week. I'm sure everybody's waiting for that press conference afterwards.
The devil's in the details, so to speak. And everyone's they're not gonna be as interested in what happens. Of course, they'll want to know whether it's 3/4 or 1%, but they're going to want to know what they're thinking about for September and
Yes.
kind of their long-term. Are they going to pause at some point, or are they just going to continue to raise rates through the end of the year into next year?
Exactly. Well, one thing we do know, it looks like they're going to continue to tighten on the quantitative easing, or now I guess it's quantitative tightening, where they're reducing their balance sheet.
Yes, in the recent past, they were buying bonds, and then they paused, and then this month they'll actually start letting bonds that mature roll off, meaning they don't reissue, and so that will have the effect of lowering the value of their balance sheet, but also reduces liquidity.
Sure. Well, and that also plays into this, where we've seen a pretty significant reduction in money supply.
Yeah, I mean, but you can see how unprecedented the increase was. We're coming off of that. And so the yellow line is showing that downward movement in the M2 money supply, which includes money market, savings account, checking accounts, not just cash. But the blue line is actually negative, and that is factoring in inflation. And so this is really dramatic when you think of the money supply shrinking, quantitative tightening beginning, and interest rates going up.
Sure.
That the Fed is putting multiple brakes on right now.
And that has had some impact, well, that and maybe a bazillion other factors on commodities, and hopefully broader on inflation as we move forward over the next couple of months or quarters?
Yeah, so we've seen the blue would be energy. We've actually seen those prices come down in the last month or so. The green would be agricultural prices. Those come down a little bit. But the interesting thing is when we look at industrial metals, they're now down on a year-to-date basis, and precious metals are also down on a year-to-date basis. And so that does provide maybe some hope that when we look at July and August CPI and PPI numbers, that they might come down a little bit with the commodity prices.
Sure. So from a market's perspective, we were just talking there about the economy, but from a market perspective, what's our outlook going forward?
Well, we continue to see volatility until there's some more clarity. And that clarity is interest rates, commodity prices, inflation, and kind of how that intersects. But the other side is we've been in a bear market now for 7 months. And so not all, but many of the challenging issues that we've discussed are likely reflected in current stock prices. So, earnings growth, I think, will be a swing factor. Certainly, I'd include the jobs market. But when we kind of look at things overall, value and international still look to be relatively attractive. Now, I will say many growth stocks have come down quite a bit and maybe are not cheap, but are kind of approaching more reasonable levels. Mm-hmm. On the bond market side, with this increase in interest rates, yields are actually pretty attractive. And we talked about how they were a little bit higher a month ago, and we've seen yields come down a little bit, helping bond prices. I think that is really reflective of those yields being attractive, and we're going to actually show that. And so I think going forward, I do think that if there's more equity market risk, that bonds will provide some risk-off protection going forward. And then, total returns going forward, I think will improve. We mentioned, kind of growth slowing, rates coming down, but at some point, if the Fed sees that as well, they'll be lowering short-term rates at some point, which will also help bonds.
So you just mentioned valuations are more reasonable, maybe not per se cheap, and we may still, even though valuations may be more reasonable, they're still red on our dashboard.
Right.
And they still could have further downward movement to go. We saw from history that this bear market, I think the low point was maybe 23% down on the S&P 500. I think the numbers show about 29% is the average. So we might have a little bit more, but nonetheless, more reasonable.
Yeah, absolutely. So we're slightly below that 25-year average. Now, of course, if earnings come down, the market isn't quite as cheap. So that's one thing to remember. But there is a bit more to this story, though. And on this slide, the green is the value of the top 10 stocks. They've come down, and those top 10 are mostly tech at this point, and that's measured by market cap. So they're not yet cheap. But if we look at the rest of the S&P 500, those that are in blue, they actually are now arguably cheap. Currently, they're about 14 times earnings relative to the long-term average of 15.7. And so, again, markets can come down a little bit from here, but a good bit of the market is actually beginning to be attractive.
Sure. So we talked about the dollar and the impact that it had on the international stocks, and you made reference that it's having an impact also on multinationals. You're saying here a reversal of the recent trend could help, though.
Yeah, absolutely. So with the downward arrow, that was, in a period where the dollar was weak. I didn't want to complicate the slide by showing international performance, but that was actually a time period where international did well. And so, more recently, we've seen weaker international returns relative to the US. Now, this quarter, we saw a very big increase. And so, If we,
And I'm sorry to interrupt, but when you say more recently, we've seen
in the
US, yeah, it's the
yeah,
last couple of years.
last couple of
several
years, but when we look at the dollar strength this year, we can see on the far right how strong it's been. And so again, interestingly, in the second quarter, international did a bit better than
Sure.
the US despite that. And so, you know, if the dollar does settle down, I don't think it will present the headwind that it has been.
Good point. Very good point. And you already mentioned here how fixed income yields have become much more attractive than
Yep.
even just a year ago.
Absolutely. So, you know, prior to last year, if you looked at yields, they were kind of at or below kind of the dividend yield. And so we have dividend kind of on the far right. But, you know, municipals are very, very attractive. The US Ag at almost a 4% yield. And then investment grade corporates a little bit under 5%. Those are very attractive yields.
Well, and one other thing that that I was just thinking about is yields on cash reserves. So not necessarily bank cash reserves, but if you got cash reserves, we maybe had been using maybe online bank accounts or ultra short-term funds for some cash reserves. But most recently, we've been buying CDs and US Treasury bills because they've been providing some pretty attractive yields relative to, relative to the last, I don't know, decade. Can you think of the last time we bought a US Treasury bill until recently?
It's probably more than 10 years.
Probably. So in any case, thank you for going through that, Jonathan. As far as our SilverOak updates, our IQs, which is our investment quality scoring system, funds overall on a relative basis anyway seem to do pretty well this last quarter. Obviously, absolute basis, everything was down. But relative seemed to do pretty well. Were there any particular outliers that you wanted to mention?
Yeah, we talked about this last quarter, and it's certainly the case this quarter, but value has done a little bit better than growth on a relative absolute basis. We've had a couple of outliers on the growth side. When we look at international, I think international has generally held its own. We have maybe one growth that's maybe an outlier.
Sure.
But everything else seems to be kind of right where we would expect it to be.
Excellent. As far as SilverOak team members, we do have joining us a new executive assistant. So I'm very, very pleased to announce Noel has started with us and is in the depths of getting trained in, which is a long process in and of itself. We also have some new mandated IRA rollover disclosures and frankly analysis requirements. This is mandated by the Securities Exchange Commission and Department of Labor. So if any clients are interested in rolling over, say IRAs or 401ks, things of that nature, and it seems like we have a bit more red tape to go through. This is not self-inflicted red tape that we're doing. It's unfortunately mandated disclosures and analysis. I guess for the whole industry is good, but sometimes can be a little frustrating when you're just dealing with more of that. And then we are working on implementing some new trading software. Very excited to mention this. We've been working on this project kind of behind the scenes for a while, but we hope here over the next 6 months to have it fully implemented and in place. It's not really going to impact performance reporting, but some of the client reports that we go through during our meetings, those very well may be impacted. If there are any additional questions, as I mentioned, feel free to reach out to your SilverOak advisor, and even if you want to suggest topics for future webinars, we appreciate that. If you're not working with a SilverOak advisor, you can contact me at 952-896-5701. And with that, I hope everyone has a great day. And again, Jonathan, thank you for your time and putting all this together.
Thank you.